Uh, we're going to do three problems on this video today. This is, again, budgetary planning, looking at three additional problems. We're going to look at exercise 12, exercise 13, and exercise 14, which I had previously sent you that information on. We have the, I'm going to share my screen with you again. Share screen. And again, we're looking at exercises 12, 13, and 14, all of which the problems and the solutions have been loaded on Sakai and available to you to read the problem, look at the solution, get familiar with the problem. But what we're going to do now is we're going to read the problem, and then we're going to look at the solution for each of these. Exercise 22-12, let's read it. Let's highlight what's important. Kirkland Company combines its operating expenses for budget purposes in a selling and administrative expense budget. So that's the budget we're going to prepare. Selling and administrative expense budget. For the first 6 months of 2022, the following data are available. Number one, sales, 20,000 units for the first quarter, 22,000 units for the second quarter. Item two, variable costs per dollar of sales. Sales commissions 5%, delivery expense 2%, and advertising 3%. If you add those all up, that's 10%, okay? So the variable cost is 10% of sales dollars. Item three, fixed costs per quarter. Sales salaries, 12,000, office salaries, 8,000, depreciation expense, 4,200, insurance, 1,500, utilities, 800, repairs expense, $500. So if you add all those costs up, it's $27,000. Just like manufacturing overhead, selling and administrative expenses are a mixed cost, which include both variable and fixed cost. We've talked about that in previous chapters. So in order to come up with the total expense, you have to calculate the variable cost. In this case, the variable cost is a percentage of sales plus fixed costs, which add up to $27,000. They go on to say that the unit selling price is $20 per unit. So you've got unit sales and you've got the sales price. Remember, the variable costs are a percentage of total sales. So you got to calculate total sales first. Now, read the instructions. It says, prepare a selling and administrative expense budget by quarter for the first 6 months of 2022. So we need to look at it first quarter, second quarter, and in total. Now, we're preparing a selling and administrative expense budget, total expense. In this problem, what you'll notice is that one of the fixed costs is depreciation expense. Remember, depreciation expense, yes, is an expense, but it's not a cash disbursement. Okay, so let's look at the solution here that I've included in my analysis. Again, it's later on here. This is 11. Here's the solution to exercise 12. First quarter, second quarter, and for the 6 months. Kirkland Company selling administrative budget for the 6 months ended June 30th, 2022, 2017. First quarter. So remember, the variable cost is based upon total sales. So the first thing we have to do is calculate total sales. They told us in the first quarter they've got 20,000 units that are going to be sold. The sales price per unit is $20 per unit. Total sales in the first quarter, $400,000. The variable costs, 10% of total sales. I added them all together. There's no need to list out all that information because they're asking you to come up with a total expense. $400,000 times 10%. The variable cost in the first quarter, $40,000. Plus fixed costs. All I did is add up all those costs that they had listed in the problem, $27,000 a quarter. First quarter, variable cost $40,000, fixed cost $27,000, total expense in the first quarter, $67,000. Let's look at the second quarter, going through the same process. Have to first calculate total sales. 22,000 units, $20 a unit, total sales $440,000. The variable cost is 10% of total sales, $44,000 in variable costs. Fixed cost per quarter, $27,000. Variable plus fixed equals total, $71,000 total cost, total expense. 6 months, just add it all together. Let's go back and look at exercise 13. Going back to the problem, we want to read the problem. Here it is right here. Fultz Company has accumulated the following budget data for the year 2022. Sales, 30,000 units. Unit selling price, $85. Cost of 1 unit of finished goods, direct materials, 1 pound, $5 per pound. Remember, always looking for quantity and price. 1 pound of material, $5 a pound. Direct labor, 3 hours, that's the quantity. The price, $15 per hour. And manufacturing overhead is $5 per direct labor hour. Manufacturing overhead is applied on the basis of direct labor hours. Item 3, inventories. Raw materials only, beginning 10,000 pounds, ending 15,000 pounds. That's irrelevant information. You're going to see we don't need to know that at all. Item 4, selling and administrative expense, $170,000. Interest expense, $30,000. Income taxes, 30% of income before income taxes. What do we need to do? A, prepare a schedule showing the computation of the cost of goods sold. B, prepare a multi-step income statement for 2022. So a budgeted income statement. Let's look at the solution. Let's look at the beginning of it. First thing they're asking us to do is calculate cost of goods sold. This is also the standard cost card. The cost card, what is it? Cost per unit. And in the Hayes Company, there was a computation just like this. Product cost, cost of goods sold. Materials, labor, and overhead. In order to get this, I suggest that you break out quantity and price for each one of the elements of product cost. And I've kind of written it at the very top. We also see their solution. Direct materials, quantity, 1 pound. Price, $5 per pound. Direct materials cost $5 per unit. Direct labor, it takes 3 hours, that's the quantity. The labor rate, the price, $15 an hour, $45 in direct labor cost. Manufacturing overhead is applied on the basis of direct labor hours. Number of hours, 3. Also from our direct labor, 3 hours. The price, the predetermined overhead rate for manufacturing overhead is $5 per direct labor hour. You got $15 of manufacturing overhead per unit. Total product cost per unit, $65. That's a per unit basis. So what is the total product cost? What is total cost of goods sold? 30,000 units times $65 per unit. Where did they get the 30,000 units for? Let's go back to the problem. Let's look at it. It says at the very beginning of the problem, follow my cursor, item 1, sales, 30,000 units, selling price $85. We'll get to that in a minute. But they're selling 30,000 units. Please remember the matching principle. If they're going to sell 30,000 units, the cost of goods sold also has to be based on 30,000 units. Part B of this problem says prepare a budgeted income statement. Starts with sales. 30,000 units is what they sold. Selling price per unit, $85. Sales, $2,550,000. Cost of goods sold. From the previous part of this problem, again, 30,000 units, $65 per unit is the cost, $1,950,000. Gross profit, $600,000. They also told you that the selling administrative expense was $170,000. And then you have income from operations, $430,000. And to subtract interest expense, you've got income before income taxes, $400,000. The income tax rate is 30% on income before taxes, $120,000. Net income, $280,000. Budgeted income statement. In this problem, they told you about inventory, completely irrelevant information. Don't need to worry about that because you have product cost per unit. Let's look at exercise 14. Let's go back to the problem. Let's read the problem. It says, this is exercise 14. Danner Company expects to have a cash balance of $45,000 on January 1, 2022. Relevant monthly budget data for the first 2 months of 2022 are as follows. Collections from customers, January 85,000, February 150,000. Payments for direct materials, January 50,000, February 75,000. Direct labor, January and February, they give you the numbers. Wages are paid in the month they are incurred. Manufacturing overhead, January and February. These costs include depreciation of $1,500 per month. All other overhead costs are paid as incurred. Why do they separate out depreciation expense? Because ultimately, when we look at this problem, they're going to ask you to do what? Prepare a cash budget for January and February. Cash budget, not an income statement. So we need to figure out cash collected and cash dispersed. Remember this, depreciation expense is a non-cash expense. It's recorded as an expense, but it's not a cash disbursement. Let's think back. What is the journal entry to record depreciation expense? Debit depreciation expense, credit accumulated depreciation. There is no impact on cash. So if you have an expense that includes depreciation, you need to subtract it. You need to subtract depreciation expense from the expense. In other words, you make sure there's no depreciation expense in the number. What did they say here? Again, manufacturing overhead, January 21,000, February 25,000. These expenses include depreciation of $1,500 per month. Because it's included, we need to subtract it when we prepare the cash budget. Next item, selling and administrative expenses, January 15,000, February 20,000. These costs are exclusive of depreciation. What does that mean? It means it's not in there. There's no depreciation expense in there. Don't have to make any adjustment. And lastly, it says sales of marketable securities in January are expected to realize $12,000 in cash. Sales, that means they're going to collect $12,000 from the sale of securities. Danner Company has a line of credit at a local bank that enables it to borrow up to $25,000. The company wants to maintain a minimum monthly cash balance of $20,000. So at the end of the month, when you do your cash budget, if they do not have $20,000, they need to borrow enough cash to get them in that position. Prepare a cash budget for January and February. Let's look at the solution. Here it is here. Danner Company, cash budget for the 2 months ended February 28, 2022. Going to work on one column at a time. Let's look at January. Beginning cash balance. They told you that they started January with $45,000. Add cash receipts. So what are they collecting cash? They told you they collected $85,000 from customers in January. And they also told you they sold some marketable securities where they realized $12,000 in collections. Total receipts, 85 plus 12 is 97. Add that to the beginning cash balance. They have cash available of 142,000. Now they make the disbursements. Direct materials, they told you that number was 50,000. Direct labor, we told you that number was 30,000. Manufacturing overhead, and you can see I made a note there, net of depreciation expense. So we take their number, subtract off the $1,500 they had for depreciation expense, it's $19,500. Selling and administrative expenses, you can use their number because they said it was exclusive of depreciation expense. They have, as you can see here, cash available, my cursor, 142,000. They dispersed $114,500. They have excess cash of $27,500. They want to have a minimum cash balance of $20,000. They don't need to borrow any money. Second month, go to the top, February. The beginning cash balance is the ending cash balance from the month before. This 27.5 carries up to February. Go through the same process. Cash collections, $150,000. They didn't sell those marketable securities in February, they sold them in January, so you've got no item here. Beginning cash, 27.5 plus 150,000 in cash collected from customers. They have 177.5 available. Going back to the problem, they say materials 75,000, labor 45,000, manufacturing overhead net of depreciation. Remember, you got to subtract the $1,500 of depreciation expense because it's a non-cash item, 23.5. Selling and administrative expense, $20,000. So they have what? Cash available, 177.5 minus their disbursements, 163.5. They only have $14,000 in excess cash. They want to have a minimum cash balance of $20,000. They have to do what? They got to borrow $6,000 for them to get there. So those are the three problems I wanted to cover. 12, 13, and 14. And I think we are all set. We'll stop sharing this here. And I hope that helps. Thank you.